चलो क्वेश्चन नंबर 4C. Next question. Sensex futures are traded at a multiple of 50. Means 50 is the lot size. Consider the following quotations of Sensex futures in 6 trading days during February, starting from 4th to 11th. High price is given, low price is given, and the closing price is given. Abhishek bought means purchase, one Sensex futures contract on 4th of February. The average daily absolute change in the value of the contract is 10,000 and standard deviation of these changes is 2,000. Maintenance margin is 75% of the initial margin. You are required to determine daily balances in the margin account and payment of the margin calls if any. So friends, over here again the question is asking about calculation of the, that is a preparation of the margin account. In preparation of the margin account, the first thing that we do is we prepare a working note for the maintenance margin. So let us see that how to prepare the working note for the maintenance margin over here. So answer of question number 4C, in that write down working note number 1, calculation of initial margin. Okay. Let us have understanding that in this question how to compute the initial margin, because it has not been provided to us expressly. Friends, in all these like the calculations, we understand logically like this, the very simple thing that if at all I am stock exchange, then in that case I will take more margin if at all the stock is having more volatility. Okay, if at all the stock is having more volatility, then I will take more margin and vice versa. That is the simple thing that we have. So the term standard deviation is what we have studied in statistics, that has been provided over here. And the term that we have understood is called mu. So it is for the initial margin, the kind of formula which has been used is mu plus 3 standard deviation. This is the formula which has been used. What is the amount of the mu? You can see that this value, the average daily absolute change in the value of the contract, that is considered to be the mu, that is an amount of 10,000. So this is 10,000 plus 3 into standard deviation. Deviation stands for volatility, dispersion. That is what we understand is the standard deviation. That is an amount of 2,000 rupees. So what we will do, 3 into 2,000. So what will happen, it is 10,000 plus 6,000. That comes to an amount of 16,000. This is a standard formula which we have for the purpose of calculation of the initial margin. The logic is like this, that whatever the prices, that prices are required to be taken, and we make the computation of the mean. The mu value is nothing else but it is the mean, that is the mean value. Standard deviation is like in our statistics we have calculated like this. I hope you recall. It is x minus x bar. We make square of the same. Then we make total divided by n number of observations. So it may be like taking into account the month data, maybe taking into account the yearly data. So this kind of, the standard deviation and mu value is calculated. Second working note, which is important over here, is calculation of maintenance margin. We can see that the information is given to us like this. then maintenance margin is 75% of the initial margin. So it is initial margin into 75 percentage. So the amount of initial margin is 16,000. Into 75 percentage. That comes to rupees 12,000. That is the way the maintenance margin is calculated. One more thing for which I want to tell you, friends, the language of the question is clearly providing that one futures contract has been purchased. But what is the price at which it has been purchased is not provided. So the institute suggested answer has made an assumption that it must have been purchased at the closing price. And accordingly, we are required to make the calculation of answer. So first of all, write down this to working note and then try to do further answer on your own. Write down a note for the answer, just a note. It is assumed that futures contract, comma, to buy Sensex is entered upon on 2nd of February, on 4th of February at closing price. So we assume that it is entered upon at the closing price. Let us see how to make the calculation of answer. We can say we can start with the 5th onwards. The high price information, low price information are of no use to us. Only the closing price information is relevant for us. So we start with the 5th. What is the closing price of the 5th? 3294.40. Write an answer along with me. 3294.40. What is the purchase price? 3296.50. 3296.50. Difference of this is the profit or loss that we have. So it is 3294.4 minus 3296.5 into lot size is 5050 into number of contracts is 1. 3294.4 minus 3296.5. So the difference is 2.1 into 5050 into 1. So there is a loss of 105. On 6th, the price is now 3212.10, 3212.30. So 3212.30. So now this becomes this becomes the purchase price now. 3294.40. Okay. So 3212.30 minus 3294.40 difference into 5050 into lot size is 1. So in that case 3212.3 minus 3294.4 difference is 82.1 into 5050, so loss of 4105. Next, seventh, 3267.50. So 3267.50 on 8th, 3257.8, 3257.8. Next, 310.02.6. Okay. Now this will become the purchase price, 3212.30. So now the profit or loss, 3267.5 minus 3212.30. Difference of that is the profit or loss into lot size into number of contracts. So the answer is 55.2 into 50, that is 2760, and this time it is positive, so there is a profit. Then this will become the purchase price, 3267.5. So 3257.8 minus 3267.5 into 50 into 1. So 3257.8 minus 3267.5, so 9.7 into 50, that is 485 is loss. Now this is the purchase price, 3257.8. Okay, so 3102.6 minus 3257.8 multiplying with 5050 into 1. So 3102.6 minus 3257.8, difference is 155.2 into 5050 into 1, that is 7760. This is the way the profit or loss on daily basis will be computed first. Right on heading margin account. In that, column number 1 is date, column number 2 is particulars, column number 3 is amount. That is the way we will have the margin account. So let us start. Preparation of the margin account will start from 4th, that is payment of initial margin. The amount of the initial margin to be paid is an amount of 16,000. On 5th, there is a loss of 105. So on 5th itself, we will have the closing balance 15,895. We know that after deducting the loss, if the balance in the margin account is lower than the maintenance margin, only in that case the margin is required to be paid. But over here, so the maintenance margin is 12,000. 15,895 is greater than 12,000, so no margin is required to be paid. On 6th, there is a loss of again 4105. So there is a loss. It is 4105. So the amount of that is the balance in the margin is 15895 minus 4105. It is 11,790, which is less than 12,000. So on sixth, balance in margin account before margin call. Why? Because the balance has dropped below 12,000. So on sixth, that is again payment of margin. The closing balance on sixth should increase equal to the initial margin, that is 16,000. Because whenever the margin is falling down below maintenance margin, then in that case, say the payment is required to be made for such an amount so that the balance increases equal to the initial margin. So I think in this case it will be 4,210. That is the amount of the margin which is required to be paid, and it is found as balancing figure. So I try to make a circle over here. Okay. On seventh, there is a profit of 2760. So there is a profit of 2760. So on seventh, the closing balance is equal to 18760. There is no information provided for the withdrawal, so we are ignoring the withdrawal. On 8th, there is a loss. It is 485. So what will happen? It is 18760 minus 485. So in that case it is 18275. So this is the closing balance of 8th. No information is provided for the withdrawal. Then 11th. On 11th, friends, there is a loss of 7760. So it is 18275 minus 7760. So 10515. So the closing balance before margin call 10515. Why that is before margin call? Because the balance reduces below 12,000. So on 11th, there is again payment of margin. What is the amount of the margin to be paid, friends? 16,000 minus 10,515. So that comes to 5,485. That is the amount of the margin which is required to be paid. So on 11th, the closing balance is equal to the initial margin, that is 16,000. Please take down answer. Dear students, over here we just have to prepare the margin account till 11th. There is not directly or indirectly any clarification is made that on 11th, so the transaction is squared off. I just explained to you that, say, if at all the transaction is squared off, then what is the profit or loss that you can reconcile. But over here, so the transaction is not squared off on 11th. So this is the way we are required to prepare the margin account till 11th.